My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to make a little money. My job is not just to entertain you, but to educate, teach you. Call me at 1-800-743-CNBC or tweet me at Jim Cramer. Okay, I can't take it anymore. I've had it. I'm tired of talking about the kind of recession we're going to have. An endless topic, even on days like today, a sensational day, where the Dow inched up 160 points, the S&P advanced 0.99%, and the Nasdaq gained 1.36%. Wowza! What a run we've had. So tonight, I'm settling everything. Tonight, I figured it out. Tonight, I'm getting graphic. Tonight, I'm explaining what everyone keeps dancing around when we talk stocks by using props to make it come to life. In front of you, I have, and I'm going to say this word wrong because I'm from Philadelphia, I have three different salsas. I've got the mild, okay? I got the spicy, and I got the ultra hot. These are the choices, all right? Right here. Now, almost no one talks about avoiding recession anymore because the Fed's slamming the brakes on the economy so aggressively. It's just going to be one of these recession sauces, the temperature of which symbolizes the depth of the recession, the size of the dip, if you will. And if you get the wrong sauce, well, it could cost you some money. So, as I recover from what turned out to be a little hotter sauce than I thought, let's run through each variety and what you do with them, starting with the one that doesn't give you a stroke, the mild. Now, for the past 8 days, this market's been trading like we're headed for a mild recession. Why? Because of the banks. Instead of Tostitos, I should be calling this Wells Fargo. Right, now, we've heard from a number of banks in the last week, and their voices spoke as one. No matter what you might hear, the consumer has a dynamite balance sheet, and most people simply aren't feeling any downturn. It's true. They're not. Now, of course, there's a percentage of people that have it tougher, and I'm not going to deny that at all. But most people, if you talk to Bank of America, a Citi, if you just talk to JP Morgan, they're going to tell you the consumer's in great shape. When you consider the strong job market and all the money people saved during the pandemic, it's possible the consumer can ride out a wave of disappointment. But we don't trade the consumer, do we? That isn't what we do here. Not here in the New York Stock Exchange. Just like the consumer. Now, they're called companies. Companies will still have a downturn in their earnings, but many stocks have already come down hard in anticipation of a deeper recession. More like this, so they're acting quite well here because they're down so much. Well, let me just give you a good example. Let's start with Micron Technology. Here's a commodity chip maker, semiconductors, with a stock that plunged from the 90s to the 50s in anticipation of a big slowdown in orders. When Micron reported, it did report an okay number. But then you know what it did? It slashed its forecast radically. What happens? Okay, sure. The stock goes down, I don't know, for like 10 minutes. It goes from the high 50s down to 53, and next thing you know, boom, right back to 63. Went out at $63.64 today. Why? Micron was already trading like we were headed for a spicy or even an ultra hot. No one was hurt making this production. If not, habanero recession. But if you think it's only going to be mild, then the stock deserves to trade in the 60s or maybe even in the 70s, where I think it's going. And then there's D.R. Horton. Yes, Dr. Horton, as people who don't know what they're talking about call it, the largest home builder. Horton reported earnings this morning that were better than expected, but then talked about elevated cancellations and a moderation in demand, although it also bought back a slew of stock. So what happens? Let's see. How much is it down? $2? $5? $8? No, morons, it was up. It was up because the stock was already very cheap. The morons, I meant to refer to the apes, are selling less than 5 times earnings. So what does that? What does the stock do? It actually soars 3.76%. Even better. Okay, so now we got to start talking that this was about anticipation. People anticipated. Save it. Now, we've been dealing with this mild recession mindset for over a week now, and it's taken up a lot of stocks, especially the bigger techs like the semiconductors. I can make it also. Let me give you some others, so it's not just about endless about Micron here. Let me go a little more worldwide. I can make a good case for buying the stock of Amazon. Buy. In a mild recession. Amazon, which makes a small acquisition today in healthcare today. See that one? Makes it easier for you to see a doctor. Okay. It traded at 188 in November. Now it's at 124. That's crazy. This is a pretty good company. Amazon's got retail, which matters because it's one of the few retailers that can get through a mild recession with flying colors. The other one that comes to mind is Costco, which my Travel Trust owns both of these. Amazon's got advertising, which is doing quite well, by the way. And then finally, Amazon Web Services, the cloud business, which is going gangbusters. Certainly a lot better than the absolutely pathetic Snap, which reported tonight. And remember, you cannot buy traditional retail stocks in this scenario. Their stuff costs too much. You know what else comes to mind? Disney. Yeah, Disney. Disney, because it just, I mean, let's face it, this stock's down from 180 to 102. It finally lifted its head north of 100. I think this one fits the mild recession theory because its stock is down huge, reflecting a severe recession, not a moderate recession. The stock's no longer being dragged down by Netflix just because it's got a streaming service, and we've already seen that the theme parks are jammed. It's what I call a chicken growth stock for those who want to buy a bounce-back candidate with businesses that will hum even a mild recession because no one's canceling their tickets to go to Disney. You know what I smell? Upgrades. All right, now how about a hotter sauce? If Wall Street starts assuming we're headed for a spicier recession, not just a mild downturn, then you're going to have to pull in your horns a bit. In the spicy scenario, you can buy the higher-yielding stocks as interest rates will start to trend down, reducing the bond market competition. But you got to only buy high yielders that can still make their numbers. To me, that means the oils. Yeah, because they're now the highest-yielding stocks, the S&P 500, led by the this stock's getting killed. I can't even. It's like hard for me to look at. It's like putting hot sauce in my eyes. Don't do that. Pioneer Natural Resources, which is now down huge from its highs. I like Pioneer because they have what's called a variable dividend. They throw a ton of money at you when times are good, and even with oil pulling back to 96 today, things are very good. They're a low-cost operator. I also like the half-oil, half-natural gas company that is Coterra, with the stock down badly, that should be able to romp. These have been crushed. We own them for our Travel Trust. If we were traders, we would have said goodbye. We're not. We're investors. We're going long-term. Follow them. CNBC Investing Club, morning meeting, whatever you want. All right, what makes me feel confident about the oils? Look, if we do get a spicier recession, remember this kind? It'll be, why will it be? It'll be because of the war in Ukraine. And the war in Ukraine is also the reason why, always carry a handkerchief, why they've got a global oil and gas shortage. So the oils, they're the ideal hedge. That's what I tell people. If things go bad, these are going to make your fortune. You may also want to buy the dollar stores in a deep recession, namely Dollar Tree and Dollar General, as that's when consumers like to trade down. I know that their smaller packages often represent a false bargain. They're candy aisles to die for. I'm telling you, they have every candy you ever had, the historical ones and stuff, like moo cows, cow tails, remember that? They're there. These stocks historically do go higher during a period of medium restaurant style. Finally, now, what happens if we're headed for an ultra-hot recession? Meaning a real picante. One that burns you not once, but twice. Hoo-ha! In that case, you have to buy the ultimate defensive plays. Now, we own a bunch of these. Oh, they're doing so badly today because it's such a good day for the Travel Trust, because I don't want to take any of these possibilities off the table. They're all within the realm of what you can buy. We know the Fed's going to raise interest rates by 75 basis points next week, and they might do it again in September after they have their August break. But, hey, wouldn't you love me to have 2 months off? Can't beat that job. If we get more aggressive rate hikes to curb inflation, well, then stocks like Micron and D.R. Horton, they will be obliterated. We will not want to own them. They're selling at 5 times earnings right now on next numbers, but you know what? They're actually selling at 20 times earnings because those numbers will be cut severely by a real mouth burner of a recession. Anything related to advertising tech, the industrials will crush you. So what's safe in an ultra-hot recession? What can you buy if someone comes to you and just says, listen, you're only allowed to eat this? I think Johnson & Johnson fits. It's just reported a better than expected quarter. It's got a AAA balance sheet, 2.6% yield. J&J splitting into two entities. It's consumer products business and its drug and medical device business. And the stock's now down used from its high last month. By the way, the only crime that it's committed has been rotating from the hottest sauce to the mildest sauce. What's rotation? What do you think? Hey, look, I'm not, you know what? Don't confuse me with those cooking shows, okay? Or that show, The Bear. I can't stay away from that show. And J&J doesn't fit the mild scenario that Wall Street's anticipating right now. But if you want a diversified portfolio, you can't just bet on a single flavor of salsa. You need something for every possibility. You know what? Just because I am a charitable guy, you can also buy PepsiCo in this darker and hotter scenario. And I don't say that just because this company belongs to PepsiCo. Crucially, you know Pepsi's doing well because they just reported a phenomenal quarter with great organic growth. We know people still drink soda in a severe recession, and its raw costs like plastic are going to come down. Finally, I like Constellation Brands because, well, beer does better in a recession than not. Modelo, Corona, Pacifico, that's a long neck. Oh, man, kids like to overpay for that one. Particularly well, kids meaning over 21, particularly well in Texas. That's where it does well. That's where its major markets are, and it's unusually hot. That's fabulous beer weather. Constellation's been hit with a wave of insider selling from longtime seller insiders, the Sands family. That's okay. Look, it's been widely telegraphed. Can't blame them. They've been sitting on the shares. I think the stocks can rebound eventually. Don't pay up for it, please, because the family will keep knocking it down, giving you the business with their sales. Get better prices. Yep, here we go. We got mild. Okay. We got moderate. Oh, yeah, that's medium. And we got severe. These are the choices, okay? This is it. No more. It's like, oh, it's going to be serious. It's going to be a doozy. We gave you the whole Tostitos thing. Can we avoid a recession altogether? There's always the chance for no sauce at all, in which case a diversified portfolio definitely won't hurt you. But that's really beyond the Fed's control. To avoid a recession entirely, you need the war in Ukraine to end, and you need the Chinese economy to fully come back online. You also need the dollar to come down. Don't hold your breath, especially if you have the cayenne sauce in your mouth. Bottom line, it's the recession, stupid. Right now, it's just the temperature that matters. Doug in New York. Doug.
Hey, Jimmy, booyah. How we doing today?
Have never been better. What's going on?
Listen, congratulations on your new digs there. I hope they got the AC working for you.
Oh, man, this is unbelievable here. Can you imagine this?
Okay.
You know, I slept here last night. It's dynamite. They don't make me leave. I never have to go home. It's terrific. Plus, my wife visited me here, so I don't even have to worry about that front. What's going on?
Attaboy. Listen, I'm calling about an old friend of ours that's been taking a real beating lately. And I know how you're feeling about companies that aren't making money right now, but I'm talking about Twilio. They're supposed to be, hopefully, cash positive by next year. They're making a big splash, supposedly, in the Canadian market. They're
doing all that. You're right. It's just that it's still losing money, so I can't. Look, I got to be true to my word, Doug. I got to be true to my word. I am saying that if they're not making money, they're not going to get my approval, even if I think they're good. However, I will say this, that if you're willing to own that for 18 months, I think you'll do very well. But that's a long time in this world. All right, so let's go over it again, just in case someone says that I didn't hear what he had to say. Mild, spicy, mad hot. The 3 possible kinds of recessions we face. There's always a chance we avoid a recession altogether. But I wouldn't hold your breath on Mad tonight. A big night of earnings. Does Dow have what it takes to be a good corporate citizen and a good investment? I'm going to check in with the CEO. Then Mattel reported after the bell, and I'm breaking down the numbers with the toy maker's top brass. And Tractor Supply fell today after reporting second quarter results. So what was that? Does the street say no to it? Why don't we dig in with the CEO? And I may suggest that you stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.